we're 10 years into an expansion. This is the longest expansion of the past century. So just based on that, you would expect a recession pretty soon, because most business cycles are 6 or so years. In other words, you have a 6-year expansion, things slow down, you drop into recession, and then you start again. Well, so we've been expanding for 10 years. So you're starting to see end of cycle behavior in a lot of sectors right now. And this raising cash is one, and then soaring debt issuance in the corporate sector and consumer sector are other indicators that we're getting kind of towards the top.
Thanks for watching this RTD interview. Don't forget to pick up your RTD Scary George round, only available at SDBullion.com. Now enjoy this interview. Welcome back to Rethinking the Dollar. Today I'm excited to have returning guest, Mr. John Rubino. He's a best-selling author, market analyst, as well as a precious metals enthusiast. And today John has joined us from vacation. So John, I appreciate you taking time for us. Welcome back to Rethinking the Dollar.
Hey, Mike. Yeah. As you mentioned, I'm on vacation. So that explains the background. I'm in a friend's kitchen using his Wi-Fi right now. And, hopefully the sound quality is good enough. But the light is definitely nice, at least.
Yes. Well, I appreciate you taking time. And so definitely I'm glad we was able to connect time-wise and everything. So, yeah, so there are a lot of things going on. And I know I wanted to speak to you directly. So here we are. So I'm excited to get your take on what's going on. So I'm curious to find out on your end. We're approaching the end of the 2019. Middle of October, a lot of things happening, unfolding right now. What are some things that you're keeping an eye on the most right now?
Well, okay. Here's what I think is the macro story right now. We've reached the limits to a lot of finance. In other words, we push interest rates down a long way, and we can't push them down too much further. We've flooded the world with newly created currency via all these QE programs, and it's hard to say how far we can go with that, but it's also safe to say we can't go to infinity with stuff like that. So we're reaching the limits of that too. But what most people are focusing on is what I think are largely irrelevant news stories right now, like the trade war with China and impeachment and things like that we kind of have to get out of the way. In other words, we have to get some kind of a trade deal out of the way with China. And it won't be everything anybody wants, and it won't be very important, but at least everybody will be able to sign off on it and say it was great and give the markets a little pop, a relief rally. Get that out of the way, then the impeachment thing has to work itself out in a way that's not catastrophic, which it will. They're not going to kick Trump out of office over, certainly not that Ukrainian phone call. And we get that out of the way, and then people will look around. The stock market will probably pop, and the financial markets will respond favorably in general when those things are taken off the plate of the financial system. But then people are going to look around and go, oh, the fundamental stuff is still really bad. And the Fed is going to have to continue to cut interest rates, and they're going to have to go to QE. And if they don't do all of those things in a really big way, then the stock market will have a nervous breakdown. And so we're back to that, which I think is the big underlying story. All this debt that we've taken on makes life extremely hard for financial policymakers and for money managers and for individuals, because it makes it hard to generate levels of growth and tax revenues and wages that allow a system to work well. Right. So we're at the point now where things aren't working right, and there's no real prospect of them returning to quote unquote normal. And so the big deal in the financial markets is when we start to figure that out, when that becomes the conventional wisdom that, okay, we've done all this stuff and it didn't work. We're not having this rip-roaring boom where everything is great, which means we have to do more of this stuff. But how much more can we do? How negative can interest rates go? In other words, we realize that the central banks of the world are out of ammo. And that's when everything gets really interesting. So I think that's a 2020 story. We have to solve these or resolve these pointless kind of fake news things like the trade war and impeachment. And we get them out of the way, and then we'll focus on the real stuff after that. And we'll be terrified when that's all we have to focus on.
Right. Now, one thing you hinted at was the quantitative easing. And so I want to get your thoughts on this repo market's activity, because I think it was last week or 2 weeks ago, Chairman Jerome Powell was very adamant in saying that, hold on, let me correct you. This is not QE. This is not the typical bond buying. This is not what we did before. This is just something temporary to calm the markets or whatever. And so is this current repo market activity, the bond leasing and lending and credit liquidity providing, is this something that's going to be temporary, or will this be, or is this QE itself for real?
Well, the really spooky thing about the whole repo thing is that nobody knows why it's happening. It just blew up all of a sudden. Interest rates spiked in the overnight bank lending market, and then the Fed had to step in to keep it from seizing up. But it's not like, one bank had its derivatives book blow up and then we can kind of fence that off and bail them out or anything. Nobody is being able to tell us anything. And any doctor can tell you that half the battle is naming the problem, right? Because then that allows your imagination to stop running wild. And so we aren't there in the overnight bank lending market, in the repo market. We don't know what did it. So therefore it could be something huge or it could be nothing. We just don't know. And we're going to worry about it being the huge thing, like some really fundamental problem with a bunch of different banks, until it resolves itself, or doesn't. Yeah. And right now the Fed is having to pump a ton of money in to keep banks lending to each other, which is basically QE. They're saying it's not QE, yeah, but it's buying securities in the open market for newly created currency, which is basically quantitative easing. So that's what they're doing. Now we are now back in QE on a fairly big scale, on not far from $1 trillion a year scale of new currency creation being pumped into the banking system. So, and that happened in a hurry without any real fanfare or anything.
Yeah. Now, in your opinion, at the end of this month, will there be an interest rate cut, and will that be a continuation from this point on out?
Well, here's how the dynamic works now. The Fed has to cut interest rates continuously for the financial markets to avoid a meltdown. Mm-hmm. And they would prefer not to telegraph that. They want to do a cut and call it something like a mid-course correction or an insurance cut, and then have the leeway not to continue to cut interest rates. But every time they tell the financial markets that, the stock market tanks, and the Fed has to come back and say, okay, don't worry, you'll get more interest rates cuts in the future, because they recognize that they're really close to running out of ammo. In other words, dropping down into negative rates like Europe and Japan are, and then having everybody wonder how much further they can go. Because, there's a thing that the economists talk about. It used to be the zero bound, where they said interest rates can't go below zero because that freaks out the financial markets. Then interest rates went below zero. And now they're talking about the effective lower bound, which is the beyond which we can't go without blowing up the global financial system. So the Fed knows that effective lower bound is out there. And the only way you figure out what it is by going there and blowing up the global financial system. So they don't want to do that. They would much rather have this be the last interest rate cut. But the stock market will collapse if they declare this interest rate cut, the last one that they did, as the last one for the next 5 years or for the rest of the cycle or whatever. So they're in a box where they would prefer not to do really extreme financial experimentation, but the markets are demanding it. Like, think of the global financial system, and especially the asset markets, as a heroin addict who is getting acclimated to heroin and needs bigger and bigger doses to not go into withdrawal and die. And if they don't get their hit, that's a massive equities bear market that leads to a breakdown in the bond market, which leads to a greater depression, something worse than the 1930s, very possibly. But if they do get it, they do get continuous, ever bigger hits of financial heroin, then at some point that blows up too, because we reach the point where the financial markets are so distorted by negative interest rates and massive amounts of asset purchases, that they stop functioning as a price signaling mechanism to tell capitalism how to work, where to allocate capital. And then the system just freezes up because you get, entrepreneurs don't know where to invest, so they start doing crazy stuff like, for instance, what corporations are doing now, where they borrow huge amounts of money and then buy back their own stocks, which is leading corporate debt in the US to go to record levels and shrinking the supply of equities out there dramatically. We're kind of doing a LBO of the public sector or public security markets right now, where companies are borrowing money and buying back their stock on such a scale that the stock is going away. And that's the kind of thing that has a really limited lifespan, because corporations can only borrow X amount of money before nobody will lend to them anymore, because their credit ratings start to plunge and their bonds become junk, which is happening now. Triple B rated debt in the US is the part of the debt market that's soaring. That's one step above junk. And a lot of those companies are borrowing more and more money, and at some point they get kicked down into junk, and that might be the catalyst that starts the avalanche and blows up the financial system. So we don't know where the end of this is, but there is obviously an end out there. Logically, there's an amount of money that you can't borrow beyond, and there's an interest rate that you can't fall beyond. And the more we move in that direction, the closer we get to that limit, and we don't know what that limit is. We don't know if we hit it at negative 1% interest rates and a Fed balance sheet of $7 trillion. In other words, currency that they created and pumped into the financial system with $7 trillion. We don't know if that's it. We don't know if it's much further than that. We don't know if it's somewhere before that. But we know we're heading in that direction, and therefore we will find that limit if we keep doing this. And that's what has policymakers so hot and bothered right now, because they know they're heading in that direction, and they aren't allowed to stop. The financial markets won't allow them to stop. So they're just kind of riding this tiger and seeing at what point the tiger turns around and bites them. Yeah.
Wow. So one thing I have noticed, more mainstream news stories are coming out now, commenting on where retail investors are looking to park some of their liquidity in cash form. And so just, I think it was not long ago, over this weekend, I think Bloomberg or a mainstream news source said that more retail investors are getting out and holding cash like never before until the last great financial crisis. So it looks like a lot of people are preparing for something and expecting something. Do you think that's going to be a continuous norm until something occurs?
Well, yeah, you're right. People are moving into money market funds at a rate not seen since 2008 or so. In other words, that's what you do when you're worried, right? You sell your growth stocks, and your brokerage house takes the proceeds from that sale and puts it into one of their money market funds. So it happens automatically when you're selling risk assets. And yeah, people are showing that they're nervous by basically raising cash in that way. And they're nervous with good reason. Stocks are at record levels. Bonds are at record levels. There's a lot of crazy stuff going on in the world that would, tend to spook you if you have a lot of money at risk in tech stocks or government bonds that yield virtually nothing, because those are the kinds of things where, intuitively, even if you don't understand the numbers exactly, but there are air pockets under the prices of those assets. And you've got some big embedded profits. So take some money off the table and sit and wait and see what happens. That's the kind of thing that can lead to a bear market in both stocks and bonds, because once people are spooked, it's hard to reassure them. We don't change our minds lightly, human beings. We fix an idea in our minds and run with that idea. We keep it for a long time until the weight of evidence becomes overwhelming that that's not the right idea anymore. And then we shift to that new perspective and stay there for a long time. So once you lose the market's confidence, it's hard to get it back. And it's conceivable that this cash raising binge that we're on right now is a sign that we're losing the confidence of investors. And that's it's an early step in the process of the cycle peaking and rolling over. We're 10 years into an expansion. This is the longest expansion of the past century. So just based on that, you would expect a recession pretty soon, because most business cycles are 6 or so years. In other words, you have a 6-year expansion, things slow down, you drop into recession, and then you start again. Well, so we've been expanding for 10 years. So you're starting to see end of cycle behavior in a lot of sectors right now. And this raising cash is one. And then, the soaring debt issuance in the corporate sector and consumer sector are other indicators that we're getting kind of towards the top. When, say you're a company and you're afraid for the future, but you can borrow money very cheaply right now, it makes sense to borrow money, right? You sock away a bunch of cash in the expectation of the next recession cutting your sales and revenues and maybe causing some losses or whatever. And you want to have that cash on hand to protect you. Well, that corporations are borrowing huge amounts of money. So the motivation in some of those cases, at least, might be that, protecting themselves against the next downturn, which they now see as possible, if not imminent.
Thanks for watching this interview. If you're enjoying content like this, feel free to become a part of the RTD community by becoming a member via Patreon. All it takes is a monthly contribution of about $5 a month for more great content such as this. Just scroll down beneath this video here and click the Patreon link, and then hit this tab right here to become a member of the team. Looking forward to bringing you more great content. Now, let's get back to this interview. Thanks. Let me ask you a question. As a part of this whole monetary policy intervention, it looks like the new norm will be whatever Jerome Powell says will determine the outcome of the global economy. Now he's really bent on saying that they can't find the inflation they're looking for. So I'm hearing a lot about, he keeps reiterating the mandate of price stability and unemployment, maximum employment. And so do you think this narrative of central bank intervention and just them controlling the way the world turns will continue on as things unfold and as this expansion comes to an end or a halt or whatever might occur after that? What are your thoughts on that?
Well, I think that, the Fed is pretty crucial right now, as it always is, but maybe more so than usual in the global financial system, because they're the last big central bank to go from tightening or promising to tighten to easing aggressively. And that means it's coordinated now. Everybody is easing out there, which is a very big deal, because that's a lot of firepower. If the Bank of Japan and the European Central Bank and the US Fed all decide to do the same thing, then they can make stuff happen, because they've got trillions and trillions of dollars at their disposal. Now, Jerome Powell, this kind of makes me sad, because I like him as a person. Every time I see him speak, I think, wow, a regular guy is running the Fed. Somebody who speaks in clear sentences and seems to have some humility about the power that he wields and the knowledge that he has. He doesn't pretend to know everything, and he doesn't pretend to, this kind of godlike power over the financial markets. He's just a guy who's trying to figure out what he's going to do next and which way he should go. And so he kind of got saddled with an unwinnable hand by his predecessors, and he's struggling with it. And I sympathize. Because it is an unwinnable hand. There's no way to get from here to normal, steady, organic growth without huge volatility and without the potential for a global financial catastrophe hanging over you every day. You can't get from here to there without that global financial catastrophe actually happening and wiping the board of all the bad debt and allowing us to start again. You have to have a crisis after you overborrow. That's just how finance works. And so he's the guy who's stuck trying to manage his way through this. And I sympathize with him. However, all the guys running the Fed and the ECB and the Bank of Japan and all the other big central banks, they're creatures of this system. They believe that Keynesian monetary economics is the way to run a global financial system. And they believe that interest rates falling are always a good thing. And the governments do have the power to manage the growth of their economies. All this stuff that's fundamentally untrue. Those are their models. That's what they believe. And that's the model that they plug their numbers into. And so it should be no surprise that they get the wrong answer, that they think something is going to happen when they do something with interest rates. And it doesn't quite happen the way they expect. According to the Keynesian financial and monetary model, if you cut interest rates to zero, you should have a rip-roaring boom, because you're telling everybody that it's time to borrow a ton of money, right? Because money's free. And that's not the way it's happening in Europe. That's not the way it's happening in Japan. There are housing markets in Europe right now where they pay you to take out a mortgage. And there are other markets where it's close to that. It's not quite there, but it's damn close. But it's not igniting a massive borrowing boom. And the reason for that is, people respond differently to different stimuli depending on where they are with their own finances. And if the system has already borrowed huge amounts of money, it becomes reluctant to borrow even huger amounts of money. And you have to really, really make it worth everybody's while. And to do that, you got to make interest rates even lower and lower and lower. And that's where we are. So yeah, you're going to see the Fed and the ECB and the Bank of Japan, along with the lesser central banks of the world, globally flood the system with newly created currency in the next few years, because they have no choice. And the impact of that is going to be, first of all, kind of unpredictable in the moment, because we've never done this before. So we don't know exactly what it'll mean in that moment when the average interest rate on sovereign debt is negative 0.5% or whatever. Already, 3/4 of major government bonds have negative yields now. The US is almost the only big country with positive yielding government debt in the world right now. And we're going to get to the point where the US isn't even part of that club anymore. It's going to have negative yields. And then what happens? Nobody knows. Anybody who tells you they know exactly what that means is just making it up, because we've never been here before. We've never run this experiment before. But I think you can say with a high degree of certainty that one of the results, I can't give you specifics about all the results, but one result will be volatility. Things will get crazier and crazier. You can't predict exactly the form of the crazy, but that things get more uncertain and financial flows become bigger and more extreme. Hot money starts sloshing around the world on an epic scale, trying to find safety or trying to find massive gains or whatever it's going to be doing at the time. And that's going to make the markets more volatile. I think we can say that with certainty, but we can't say whether they melt up or melt down, or where the first domino falls that knocks all the other dominoes down. All of that is to be seen as part of the experiment. But it's definitely going to be one of those things that economists and historians are writing about a century from now. We are living through the most amazing financial experiment that never should have been tried, but by God, it is going to be tried.
Yeah. Now, part of that volatility that you were referring to, I would imagine a lot of that will pertain to financial products that have been spun out in all forms and fashion of digital as well as paper type assets that will probably be exposed for more liabilities at the end of the day. But along with that, where I anticipate that the nominal price of safe haven assets, preferably gold and silver, might also be on the receiving end of a lot of that activity. And so if we're going to experience unprecedented volatility like never seen before in modern history, I would also assume that we might receive some pricing of metals like never imagined globally. And so what's the likelihood of that being a real scenario?
Well, you would think that precious metals, as forms of money that can't be inflated away by governments, and which have done brilliantly in past periods of extreme financial instability, are going to do great again. You would expect that. And one of the reasons that I'm 99.999% certain that that's the case this time around is the relative size of the gold and silver markets and the rest of the global financial markets. We've been creating immense amounts of new paper wealth, quote unquote wealth, out there. And we've only been increasing the gold and silver supply by maybe 1 or 2% a year. So the imbalance between paper wealth and real wealth, which gold and silver are at the peak of that pyramid of real assets out there, that implies that even a tiny fraction of global investable capital flowing into precious metals would be immense compared to the amount of gold and silver that's available for purchase, which means that they could just take off without even a huge change in investor behavior. Let's say, right now, the average portfolio is less than 1% invested in gold. Let's say they went to 5%, which, by the way, some big time mainstream money managers are recommending now. Ray Dalio.
But are they recommending ETFs or actual physical gold?
Well,
all-time high and.
Yep. Money's flowing into the gold ETFs like GLD, and that's not really gold, and people don't get that yet. But that's a sign of interest in the subject, and therefore that can be the beginning of a broader move in gold and silver. Because I've had people asking me about that. What do you think of ETFs versus physical? I get that question a lot. So people are wrestling with that. They're thinking about what it means, and the fact that money flows into GLD isn't as good for gold as it was flowing directly into physical, but it's still good. And once gold starts rising and starts taking silver along with it, all forms of precious metals will be interesting. They'll become things that that merit front page news in the financial press because they're the best performing asset out there, blah, blah, blah. And, so then you get this momentum thing going where people who really weren't interested or conversant in precious metals see them moving and jump on because their chart says, oh, we broke out of the 200-day moving average and we want to buy this asset. We don't even care what it is. It's just moving the right way. So you get the momentum flares in precious metals. And if it's just from 1% to 5% of the average portfolio out there, that's so much more money than now exists in the precious metals markets that they could just take off. They could gap up like crazy. And I think silver benefits more than gold from this because silver is a much smaller market than gold and silver's way cheaper. So, if gold goes to $2,500 an ounce and you're an individual wanting to cash out some tech stocks and buy some gold, you look at what you get for $2,500, a coin about the size of a $50, and that's it. But when you look at silver, you get a box of silver for $2,500, so it's much cheaper and much more visually interesting to buy silver when there's a big gap between the gold and silver price the way it is now, and you've got some money to spend. So silver, that's why silver outperforms gold during precious metals bull markets, because people are slightly intimidated by the price of gold relative to the size of a gold coin, and so they start looking around for something else, and they say, well, silver's sort of like gold, it's in the same category, but it's way cheaper. I can get way more gold or silver eagles than I can gold eagles for the money I have to invest. And then so silver will do 2 or 3 times as well as gold, which is to say the gold to silver ratio will drop from the current almost 90, which is historically really high, to 30 or 40. Or maybe lower than that. It's gotten as low as 20 in the last couple of cycles. So if we were to see that, then that means gold goes to $5,000 an ounce and silver goes to $200 an ounce, which is a way bigger percentage move for silver than for gold. Which means that you want to be buying silver in this kind of a circumstance. Now is just a good time to do that. It's cheap relative to gold. Precious metals are cheap relative to financial assets. And all the central banks of the world are easing. That's pretty much textbook for precious metals. Those are the circumstances under which you want to ride the next cycle that is clearly coming based on all the macro things going on out there.
Yeah. Now, as we draw towards the end of our discussion, I'm curious to get your thoughts. And of course, this is just an opinion, but recessionary talk. And more mainstream news is talking about recession. They're using the word recession, and it's being welcomed by a lot of people. So you hear stories about money markets, cash and all the things that people are responding to that. Do you see an actual recession as far as it being felt first or being told to us first before it actually unfolds? And so we know all the indicators are flashing red. Will people really wake up to the fact that recession is present, or will they have to see it first in order to believe it, in your opinion?
Well, usually the way it works is we go into recession And the government is still saying, no, we're seeing good growth. Don't worry, don't worry. And then afterwards, they go back and they go, oh, okay, we date the start of the recession from this date, which is 3 or 4 more months before the government finally admits that there's actually trouble and stuff. So, I don't think we're in recession yet, but there are some rollover kinds of stats out there where, manufacturing isn't looking as good as it used to. And some housing markets are starting to slow down, and the general GDP forecasts are starting to trend down. They're now around 2%, which is not nearly fast enough to stop the growth of debt to GDP. In other words, that we're heavily leveraging ourselves if growth is only 2%. And Germany is reporting numbers that imply they are in recession right now. So we're seeing reasons for concern out there from a growth standpoint. And the central banks of the world are kind of preemptively trying to do something about that. So it's a question of whether this slowdown snowballs into an actual recession, or whether the new QE programs and lower interest rates that we're seeing to preemptively stop this have an effect. And again, it's an experiment. We cannot know how all this works, but it definitely looks like we should expect lower corporate profits from US companies in the year ahead, just because when things slow down a little bit, that has a disproportionate effect on corporate profits. If sales drop by 5%, corporate profits can drop by 20 or 30%. And you're still profitable. You're just making 20 or 30% less than you did the year before because your sales are down by 5%. It's not an end of the world kind of thing, but it also doesn't support really expensive stocks out there. If corporate profits are falling, hard to justify paying record high levels for stocks that you're buying. So that's a threat to the stock market, which in turn is a threat to the economy in general, which in turn is a threat to the global financial system. It won't take much to tip this whole thing over. So a drop in corporate profits could be the catalyst. It's really a search for the catalyst now, because something's going to happen to blow this thing up. We don't know what it's going to be, but there's a lot of things out there that could conceivably be that. And we haven't even talked about geopolitics and war right now. God, the Middle East is just on fire. And should the U.S. right now, there are 2 coalitions there. There's the U.S., Saudi Arabia, and Israel versus Iran and maybe Russia and China. And if we get into it there, which we're kind of threatening each other to do, then that all bets are off for the financial system. The minute a U.S. unit engages a Russian unit in Syria or something like that, forget it. You sell every stock you have just because, my God, that's potential World War III, or at least a pan-Arab war that might affect the oil price. At a minimum, that shoots oil up to $100 a barrel and changes the financial calculation for pretty much everybody in the global economy. And so we're looking at, we're kind of dancing around that possibility right now with everybody shooting at everybody else over there. And that's another thing. There's so much stuff that can go wrong, which is how it works when you borrow way too much money. You create chaos in your life when you borrow more money than you can pay off. And that's what the global financial system has done. Every big country now is in that state financially. Therefore, little things that didn't used to be systemically threatening are now systemically threatening. And there's a lot of little things like that.
Ooh, well, that's a lot to swallow right there. Well, John Rubino, it's been great having you here. For those that may not be familiar with your work, can you point them back in your direction to stay in tune with what you have going on? Yeah,
I run a Lumindoom website called dollarcollapse.com that talks about a lot of this stuff and is updated daily. So you can show up anytime during the day and see pretty much what's going on with all the the dark side of the financial world issues.
Sounds good. Well, once again, John, it's been great having you on the show. Looking forward to staying in tune with what you have going on, as well as down the line, have you back on, and hopefully we're in a better environment at that point. But other than that, it's been great hanging out with you again. And so good luck with everything you do, my friend. I appreciate you taking time for us.
Thanks, Mike. Talk to you soon.
All right.